Have you ever been forced out of a trade only to see the price move exactly as you predicted? It's like being benched right before your team scores a winning goal. Many traders experience this frustration, and often delta-based stops are to blame. Today, I want to break down exactly why I never use delta-based stops in my trading strategy and what I do instead to avoid massive losses. For those new here, hi, my name is Mark Anderson. I'm a construction worker turned zero-DT hedge fund manager. I run a zero-DT hedge fund that has sold over $50 million in zero-DT premium. First, let's define what we're talking about. A delta-based trade is when you enter or exit an option based on the option's delta. Say if the delta moves from 25 to 40, you would close that trade. On the surface, it sounds logical. Delta measures how much an option moves relative to the stock price, so adjusting based on it should keep your risk in check, right? Well, not exactly, because depending on how fast or early in the trade the position moves from a 25 to a 40 delta, it can drastically change the price impact and the amount you lose at that same delta level. Think of it kind of like adjusting your speed limit based on how fast the car is going at that moment. If you only focus on your speedometer without considering road conditions, you might slam on the brakes when you don't need to, or even worse, speed up right before a tight turn. Here's the issue. Delta is not static. It moves based on price, volatility, and time decay. Using delta for stops is like trying to predict the weather by looking at only the temperature alone. Sure, it tells you something, but if you don't account for humidity, wind speed, or pressure changes, you might dress for a sunny day and walk straight into a thunderstorm. Delta-based stops introduce problems because they don't account for the expected value equation. Expected value is determined by three factors: the win rate, the average win size, and the loss rate. If you use a delta-based stop, you are unknowingly feeding poor inputs into this equation. Let's go for an example. Say you always enter a 15 delta put. This means your trade has an 85% chance of winning and a 15% chance of losing. But if you apply a stop-based delta on that trade rather than a fixed multiple like 2x, the loss size can vary drastically based on the path dependence of that move and the expansion of volatility when you get stopped out at that delta. If the VIX is at 15, you may collect $10 in premium and risk $30 with a 3x stop. But in a high VIX environment of 30, you might collect $25, meaning that your stop loss would be near $75. This inconsistency creates sequence risk and asymmetry in your risk profile, making it harder to achieve consistent results. The same problems apply when exiting a trade. If you exit on touch or at a 50 delta, the outcome can vary widely, depending on when that delta is hit. If the trade has been on for 4 hours and the delta slowly rises to near 50 delta at the end of the day, you might only lose half of the premium you collected. But if the delta spikes to 50 right after you enter the trade on a sharp down move, and the implied volatility expands drastically, you could lose 4x that premium amount. Let's say you enter a 30 delta put right before a big market event. The stock drops slightly, but implied volatility remains unchanged, causing the delta to rise to 45, with near no difference in the price of that option. If you're using a delta-based stop, you'd exit at that 45 delta, even though nothing has fundamentally changed with the trade because all the movement is contingent on the future event and held up in implied volatility. This is why I prefer managing risk using fixed stop losses rather than delta-based exits. With a fixed stop loss, I set my risk at a predefined multiple of the credit that was collected. This way, regardless of fluctuations in implied volatility, I maintain a consistent risk parameter. For example, if I collect $10 in premium, I may set a 3x stop, risking a maximum of $30 per contract. Whether IV expands or contracts, my loss remains fixed and predictable. This approach eliminates the uncertainty of delta-based stops, where losses can vary widely depending on shifts in volatility over time. Let me show you a real-world example. Recently, I was tracking a trade on SPX where I sold a 30 delta put at a price of $10. The price of the stock moved down significantly, but the real shift came from implied volatility increasing dramatically. My stop was triggered and I got out within a few minutes, losing $20 or my predefined stop loss of 2x the credit collected. If I had used a delta-based stop at a 50 delta touch, it would have taken longer to get stopped out, but since it moved so quickly from the shift in implied volatility, I would have paid $60 or a 6S stop to close that trade out. You can see here that even if the stock rebounds, it would have to do so 3 times more frequently to make up for those large losses on quick moves with delta-based exits. This ties in directly to the law of large numbers. Over a significant number of trades, results tend to converge towards the true probability. But in small samples, variance plays a much longer role in your trading profits. If I had an inconsistent trade sizing method, this single event could have disproportionately impacted my results. Additionally, there's also sequence risk that comes into play. If a trader happens to take larger trades during a streak of losses, it can heavily skew their long-term performance, even if their strategy has a positive expected value over time. This is why it's crucial to manage your trade sizing and risk consistently. To avoid these risks, I focus on a few things. 1. Consistent trade sizing. Keeping my trade size the same means I don't accidentally risk too much when things go wrong. If I change my trade size too often, I might win small and lose big, which makes it hard to recover from. 2. Applying the law of large numbers. If you flip a coin a few times, you might get heads 5 times in a row. But if you flip it 1,000 times, it will land on heads about half the time. Trading works the same way. Being consistent over many trades helps the numbers work in your favor. 3. Managing sequence risk. If I have a bad streak of trades and I happen to be betting bigger, I could lose way more than I planned. That's why I always keep my trade size steady so bad luck doesn't throw off my long-term results. 4. Avoiding asymmetric return compounding. If I lose 50% of my money, I have to make 100% back just to get to even. Keeping losses small makes it easier to recover from. Think of it like a hole in the ground. The deeper you dig, the more effort it takes to climb out of. 5. Using price-based exits. Instead of letting Delta tell you when to exit, I use a set price-based stop, risking the same each time. This keeps my risk steady and helps me avoid surprises from quick market moves. By following these principles, I reduce unnecessary stop-outs, improve my risk consistency, and create a more predictable edge over the long term. Delta is useful for trade structuring and offsetting risk with hedges, but it's not a great tool for stop placement. By using smarter exit strategies, you can avoid unnecessary stop-outs and let your trades play out the way they should. If you want to dive deeper in professional option trading strategies, subscribe to my channel below or visit my website.